Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the theory aspect from Chapter 9, which is on current liabilities and long-term debt. And in particular, we were discussing bonds in the previous video. Okay, as I said in the previous video, this is going to be several videos that'll cover the idea of bonds. I'm going to pick up where we left off, so go back and watch the previous video. I mean, that covers a general idea as to what we're doing with bonds, and how and why we buy bonds, or why bonds even exist. All right. Um, Make sure that you read the textbook in order to understand the terminology, because I'm not going to go over terminology. And like I said in the last video, I presented things from a high-level overview as to why we even have that bonds as a financial instrument. I'm going to go slowly through this, so pause, rewind the video as much as you need to in order to be able to understand the idea of bonds. And I'm also going to be presenting these from the way I think about bonds, which obviously aligns with what's in the textbook, but it allows me to be able to have some kind of structure in my mind when I think about bonds. Bonds on the surface seem very very complicated, especially if you just read through the chapter real quick. You're looking at things like par and discounts and premiums and interest and making entries and time frames and all of this kind of stuff. But the reality is they're not that difficult if you understand the underlying structure. Okay, so and that's what I'm going to try to go through and present this slowly. All right. Now, I kind of like left off here, as basically as an introduction. So now I'm going to actually kind of like start talking about bond prices. All right, so let me erase some of this here. And let me start talking about bond prices. Now, if you read through the chapter, you'll see we talk about issuing bonds at par. We talk about having a discount, and we talk about having a premium. Okay. First off, bonds, and I'll get into these three ideas, and I think that's what we're going to cover in this video, is the idea of par, discounts, and premium. But we have to understand how the pricing of bonds to a certain extent. Okay, bonds are generally, not always, but the vast majority of times, they're issued in $1,000 increments. In other words, when you buy a bond, you're going to buy $1,000 bond. Okay. If you wanted 5 bonds, it's going to cost you $5,000. Well, it's not going to cost you $5,000. It's the face value is going to be $5,000, but you're going to buy them at a present value of the $5,000, depending upon the time frame of the bond. Okay. So, but the important thing here is that what we're considering is the bond price. When you buy one bond, that bond you're buying is $1,000. And again, it can be different, but that's an outlier. That's something that is unusual and doesn't happen that often. If you went to the bank and you wanted to buy a bond, a Treasury bond or a T-bill from the bank, okay, and before to try to set more of a standard stage, let me just bring this concept into play. A T-bill and a treasury bond. If you go into the bank and you want to buy, let's say, T-bills and treasury bonds are sold by the government. In other words, you're buying those bonds from the government, and from the government of the United States, and that's an IOU. So you're giving the government money and they promise to pay you in the future, the face value of that T-bill or Treasury bond. Now, when you buy the Treasury bonds, they're basically 30 years. Okay. So if you buy a Treasury bond, the face value doesn't become mature for 30 years from whenever you buy it. T-bills are for shorter time frames. A popular one is 10 years. Okay. But it doesn't mean that you can't buy T-bills for 2 years or even 6 months. Okay. Um, so those are, the common ones. And like I said in the last video, you could buy bonds from things like municipalities or private companies that are floating a bond. All right, like I gave the example of King's College. But the vast majority of bonds that people buy, they'll walk into the bank and they'll either buy a T-bill for a specific time frame, whatever that frame is, or they'll buy the Treasury bond, which is 30 years. Okay, so when you buy the bond, you're buying the bond as a face value of $1,000, and let's just talk in terms of T-bills at 10 years. Okay, so that we have a kind of like a standard here, right? So you're going to buy that T-bill. Actually, I should just say Treasury bonds at 30 years. It's just a matter of me getting accustomed to presenting it the same way all the time. All right, so let's say we're buying a Treasury bond. So what that means is that the face value is going to be $1,000, and 30 years from now, we're going to get that $1,000 back. Okay, but when you go into the bank and you buy it right now, you're not paying $1,000. You're going to pay something less. Okay. And that something less is based upon the present value of that $1,000 today. Right? Now, that's what you'll and let's just say the interest rate, and I'm just going to make something up here. Let's say the interest rate is 8% for interest. Okay, so notice that we have three variables here, or we have three things that we have to pay attention to: the face value of 1,000, the term, which is 30 years, and the interest rate. Okay, those are the major variables as far as a bond is concerned, right? So if I go into the bank and I want to buy, that $1,000 Treasury bond, at 30 years at 8%, maybe today I'm only going to spend $300, right, in order to buy it. So what that means is that 30 years from now, I'll get the $1,000 back when it reaches its maturity value, and during that time I'm going to be collecting 8% interest a year every year for the 30 years. Now, that's looking at the bond itself, but we have this idea of par, discount, and premium. All right, bonds are, they're a financial instrument, so they're able to be bought and sold out on the open market. Okay, just like a stock. And this is where association, if you understand something about the stock market, you can associate bonds with the stock market in order to be able to understand them a little bit better. Okay, when we have a stock, and let's just say, and I'm going to make things up here, Apple stock, right? Apple stock, let's say today is trading at $600. Okay. If you wanted to buy one share of the Apple stock, you'd pay $600. And of course, that price can either go up or that price can go down. If it goes up, you're making money. If it goes down, you're losing money if you're buying the stock. Okay, I'm not going to get into short selling. That's way beyond the scope of what we're talking about here. But for right now, if you understand the idea that if you buy Apple stock for $600 and it goes up to $610, right, then you have made, and you sell it at $610, you've made $10 on it. The price of that stock appreciated. If the price of the stock goes down to say 585, right, Well, now you're losing $15, right, on the price of that stock if you sell that stock at 585. So you'd lose $15. That's the way a stock works. Well, the same exact thing happens with bonds on the bond market, okay, except they use different price points, for a lack of a better word. If I have this here $1,000 bond, all right, at face value for 30 years, because it's a Treasury bond, at 8% interest, okay, you know, I can, go into the bank and I can buy that Treasury bond. Well, the government can go and put that out on the secondary market, okay? The secondary market meaning the bond market. And the way this works is the face value of that bond is given the designation of 100, okay? That's the par value of that bond. That's the price. Even though it's $1,000 face value, okay, face value is not the same as par, okay? If you notice, all they've done is just lop off 10, okay? So if I see a bond that's at the price point of 100, right, then I know that's at par because that 100 represents the $1,000 of the face value of the bond. Okay, so that's par. Now, as I said, the price of that, because it's on the secondary market, the price of that bond can go up and it can go down. All right, it can go up to $101. I'm sorry, it could go up to 101, or it can go down to, say, 98. If it goes up to 101, okay, that means that the bond is selling at a premium. Meaning you're getting more than the par value of that bond. Remember, um, the bond's value is, you're going to be able to redeem it at only $1,000, okay? But the person who's selling it to you is going to get, now watch what I'm doing here. If we're selling it at 101, all right, that means, and we tack on a 0 on the end, that means they're getting a premium of $10 on that bond. Okay, that's why it's a premium. I mean, they're the one that, you're going to buy it at 101. That person that's selling it to you is going to get $1,010 for that bond. So they're making $10. So that's at a premium. If on the other side, they sell it to you for 98, right? That is known as selling it at a discount, right? Why? Because you're buying it for less than what you're going to cash it for. So think about it by adding on the 0, and that's, $20 now, okay? That less than what you're paying $20 less than what you're going to redeem it for, okay? So you're getting that bond at a discount, all right? So the idea being here is that for a discount, right, the stated rate, and the stated rate is 980, is less than the market rate. Okay, and for a premium, the stated rate is greater than the market rate. Okay, the premium being the 101. Okay, so let me kind of like go over that again, and I'll stop here. Excuse me. That'll be the end of this video, but let me just kind of like go over it again. The face value of a bond is $1,000. Okay, mentally, kind of like in your mind, lop off that last zero, because that $1,000 on the market has a set price has a rate. Okay, so that's a rate of 100, and that 100 is par, right? Because I lop off the one, we're looking at par being at 100. Okay, now because it's on the open market, those bonds can be bought and sold. Okay, so the price can go up and the price can go down, right? If the price goes up to say 101, right, it is selling at a premium. Why? Because you're paying more for it than what you're going to get back for the face value of it. Okay, the person who's selling it to you is actually getting 1,010. See how I added the zero back in? They're going to get $1,010. So they're actually making $10 over what they paid for it at par, which is par being 1,000. They're getting 1,010 back. That's called a premium. Okay. If the price of the bond goes down to say 98, okay, and you buy it, you're buying it at a discount. Okay, the difference between the 98 and the 100 is 2, but remember, think in terms of adding that one extra zero at the end. So basically, you're buying it at a discount of $20 less. Okay, because you're going to pay 98 for it, but when you go to sell it, when you go to redeem that bond, you're going to redeem it for $1,000. So you're actually going to make $20 on it because you bought it at a discount. Now, as I explain this, the thought might jump into your mind, well, why would I ever want to buy a bond at a premium? Okay. Remember, it's just like the stock market. What you're doing here is you're speculating whether the price will go up or down. I mean, if the bond is trading at 101, okay, but you think that the price of that bond is going to go up to 106, okay, well then yeah, you're going to be willing to pay that premium, all right, at 101 because you're expecting it to go up to 106, and you're going to make 5 points on that bond, or $50 on that bond. And this is just a corollary, an aside, when the price of stocks go up, the price of bonds goes down, okay? And when the price of stocks go down, the price of bonds go up, okay? So right now, at this point in time, the price, this being January 20th, 2016, we're hearing a lot on the news of the stock market is getting ready to go down. We're losing 250 points today, blah 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 blah. And so what happens is the people are taking, if they're afraid that the stock market is going to go down, they're taking their money out of the stock market and they're putting it into bonds, because the correlation between stocks and bonds is inverse. When one goes down, the other goes up. When one goes up, the other goes down. So if the stock market is going down, that means bonds are going up. So they're willing to pay a premium on the bond because they're expecting the bonds to go up. Okay. And conversely, the same with, if the stock market was going up, right, the bonds would be going down, and people would want to be buying it at a discount with the hope that if I could buy it at 98, and now all of a sudden the market is going to start crashing, the value of that bond is going to increase and I'll make money on it. Okay. So basically it's just another financial instrument that is being traded on the open market with the idea of, how do I make money? I buy and sell, buy high, buy low, sell high. Okay. Or buy high, sell low, in order to make the money. And it's really that simple. If you understand the stock, the price moving up and down in the stock market, then you understand the price moving up and down in the bond market, with the exception that because it's not a publicly traded company, right? They set the value of the bond at par. Okay, they set it at par in order to give it some reference, and then from that par, it goes up, and that's a premium. And if it goes down, we're buying at a discount. Okay, from this, the market rate is, from the stated rate. Remember, this here, par is the stated rate. Okay, so that's kind of it on how we look at the price of a bond. So if you're, if you see 5 bonds at $100 par, right? Well, you know that the face value of those 5 bonds is $5,000. Okay, because $100 in par represents $1,000. Okay, and you're buying 5 of them, so 5 times 1,000 gives you 5,000. If the bond price was 101, all right, you want to buy 5 of those bonds at 101. Well, the face value of that, remember, 101 is the price. The face value is 1,010. So if I buy 5 of them, I'm getting $5,050 for it. All right. Okay, so that's it for understanding, par, discount, premium. Pause the video, go back and watch it again in order to be able to understand that relationship. And if you still don't get it, feel free to telephone and contact an instructor. Okay, because basically now we've covered, bond prices, and first of all, in the last video we covered kind of like what is a bond and why it's a financial instrument, and now we looked at the price of the bond as far as face value, and as it's selling at par, a discount, or premium. So in the next video we're going to actually start getting a little bit more in depth um, as far as discounts are concerned, right? But I'm actually going to discuss issuing, making the journal entries for issuing bonds at par, and then we'll start, because that's relatively easy. And really, I don't need to explain too much more other than what you read in the textbook. But then we'll start getting into the aspect of what do you do when a bond is at a discount. So I will see you in the next video.